A family trust lets you distribute income to any family member in any amount each financial year. That's why they're one of the most powerful tax planning tools in Australia. And after helping over thousands of clients structure their businesses over the past 17 years as a chartered accountant, I can tell you, it's not just for the wealthy, despite what you may think. A family trust can save an average family thousands in taxes by splitting income between each family member instead of having it all taxed under one person's name. But setting up a trust isn't always the right move. Get it wrong and you could face a 47% tax rate on undistributed income, complex legal obligations, and yearly administration costs. So in this video, I'm going to share the pros and cons of a family trust and the exact mechanics of how a family trust works, how to distribute income to reduce your family's taxes, the real setup and running costs of a family trust, and whether a trust structure makes sense for your current situation. So let's jump straight into it. I'll start by explaining the mechanics of how a trust works first. When you own something personally, it's simple. Your name is on everything: your house, your business, your investments. A family trust changes this completely. If I were to give the most basic explanation of how it works, I'll compare it to a parent opening a bank account for their kids. That account and the money technically belongs to the kid, but the parent is the person responsible for it and is ultimately in control of the account. So you have the trust structure, which is essentially just a way to describe the relationship between the trustees, being the parent, and the beneficiaries, being the kids. Another easy way to explain this would be to think of a trust as a jar of lollies. The jar is the trust, the lollies are the assets within the trust. Then you have the trustee who dishes out the lollies and the beneficiaries who receive the lollies. Easy peasy. The trustee can be one person, a few people, or even a company, and they are the legal entity that owns the assets and makes the decisions on behalf of the trust and its beneficiaries. In most cases, the trustee is usually a company that the parents own and control, and the beneficiaries are the parents and the children and any other family member. The trustee owns and controls the trust assets and distributes income and must follow the obligations of the trust deed and act within the best interests of the beneficiaries in mind. The trust deed is the legal document that establishes and governs how a trust operates. So it's basically the rule book of the trust. And it also explains how income can be distributed, what decisions trustees can make, how assets must be managed, the process for appointing or removing trustees, and who are the important people of the trust. The trustee is also responsible for registering the trust for tax purposes, lodging tax returns, and meeting any other tax obligations on behalf of the trust. Then you have the beneficiaries. These are the people who benefit from the income that the trust generates. As I mentioned before, beneficiaries are usually the members of the family, but it can also be a company. For example, the primary or default beneficiaries may be a parent or parents, and the secondary beneficiaries may be the children, grandparents, and any companies owned by the parents. Beneficiaries will generally include their share of the trust's net income as income in their own tax returns. And if they receive income from other sources like wages, they'll be taxed for these as well. So what would be the reason you choose a family trust structure over just owning the assets in your own name? Well, there are two major benefits of structuring your affairs like this, and that is asset protection and tax planning. I'll start with asset protection. The best way to explain this is to use an example. So let's say you're a surgeon with a private practice. You own a $2 million investment property and share portfolio worth $500,000 in your personal name. Something goes wrong in the procedure and a patient files a malpractice lawsuit claiming $3 million in damages. Even with medical indemnity insurance, your personal assets are at risk should the insurance not cover the full cost of the damages. And I've been in business for quite some time now. You'll soon realize that just because you have insurance doesn't mean you're always covered. But if these assets were in a family trust, they generally protected from any legal claims. But a quick disclaimer here, I'm not a lawyer and it's best to seek legal advice when it comes to this. This is obviously more relevant to people who run businesses and need to have some sort of protection in place. The second major benefit is tax planning, because the trustee has the flexibility to distribute income as they deem relevant. They can make income allocations and take in consideration each beneficiary's tax circumstances. The most common way you can do this is distribute more income to beneficiaries with a lower marginal tax rate, because they'll pay tax at a reduced amount compared to beneficiaries at a higher tax rate, like this guy. This way, you can minimize the general tax obligations of family members who benefit from the trust. And if the income with the trust gets too much to distribute effectively, a family trust can also distribute to a separate beneficiary, such as a bucket company, to cap the tax rate at 25 to 30%. There are also a few other tax benefits, like the access to the 50% capital gains tax discount when any asset the trust has held for more than 12 months or longer is sold. So those are the two major benefits. There are, of course, a few other positives to this strategy, like estate planning. For example, you may prefer to avoid having to transfer assets via will and instead have your family continue benefiting from the trust income. This way, they avoid potential stamp duty and capital gains tax obligations if you pass away. Now, there are a few downsides you have to consider with family trusts. I'll start with the most obvious, and that's the extra admin and costs. You need to make sure you're regularly getting the right tax and accounting advice throughout the life of the trust. These costs generally around $2,000 to $3,000 for even just a simple trust. But the more complex the structure becomes, the more expensive this fee gets. So this includes preparing the tax returns, getting advice, and doing all the bookkeeping as well. The other thing that you have to consider is that any income earned by the trust that is not distributed to the beneficiaries is taxed at the highest marginal tax rate, which is 45%. If you find you're making a lot of profit as a family trust, those profits must be pushed out to beneficiaries. You could run out of beneficiaries, and those beneficiaries will be paying the highest tax rate as well. So you just have to make sure your strategy accounts for this. To be honest, these days with the cost of living being so high, most individuals will have some sort of income, which will mean it's harder to distribute income to these beneficiaries with low income. The trust also can't allocate tax losses to beneficiaries. So if it runs at a loss, it's essentially trapped in the trust structure until the trust makes a profit again. In certain states, family trusts are penalized with higher land tax. This can also be a deterrent to using a family trust for a property investment. These are the things you would have to consider when deciding whether a trust structure makes sense for your circumstances. But if I were to say when it's most suitable, I'll say it's for business owners or investors who have significant assets they want to protect, like that surgeon example I mentioned earlier. If you're in a profession with high liability risks, medical professionals, builders, consultants, or just building substantial personal wealth, a trust actually makes sense. Have family members in different tax brackets. If you've got a spouse who earns less income or adult children who study at university, you can distribute trust income to them at a lower tax rate. This is particularly powerful when your business starts making over $180,000 in profit and you want to distribute to low income earners. Are planning for generational wealth transfer. If you're building assets you want to pass down through generations while minimizing tax implications, a trust gives you this flexibility. On the flip side, I wouldn't recommend a trust if you're just starting out and earning under $180,000. You don't have significant assets to protect. Your family members are in all high tax brackets anyway. The $2,000 to $3,000 annual accounting costs would eat up too much of your profits, or you're investing in property and can get hit by significant land tax costs per year. Remember, a trust is a tool, not a magic solution. It needs to align with your specific circumstances to be worth the setup and running costs. If you're not sure if a trust structure is right for you, I would say go speak to an accountant or a lawyer to get the best advice possible. And if you want to consider the foundation of how other structures work, like a company or a SMSF, I would suggest you check out this deep dive I recently did for property investments. See you guys next time.